Three sectors under pressure in 2025: tech, AI, and financials, but each hides hidden opportunities. The U.S. stock market in 2025 is in a period defined by transition, uncertainty, and renewed opportunity. Investors are closely monitoring macroeconomic forces, such as interest rate policies, inflation dynamics, and global geopolitical shifts. At the same time, sector-specific trends are playing an outsized role in shaping portfolio strategies and valuation outcomes. Three of the most scrutinized areas are technology, artificial intelligence, or AI, and financials. Each sector operates under a unique set of pressures, but each also offers opportunities that could redefine leadership within the U.S. equity market over the coming decade. So, let us examine each of these three sectors individually to understand how they are faring in 2025 and what the outlook means for investors. Technology. Innovation powerhouse under macro and regulatory pressure. The technology sector has long served as the backbone of U.S. market growth, with mega-cap companies dominating index weightings and institutional portfolios. Yet this dominance has also made the sector highly sensitive to both macroeconomic and political developments. Two primary challenges define the current environment. First is the macroeconomic challenge. Technology stocks are disproportionately impacted by interest rate fluctuations. Higher yields tend to compress the present value of future cash flows, exerting pressure on valuations of growth-heavy companies. In recent quarters, rising bond yields and tighter financial conditions have led to periods of correction across the sector. Second, we have the regulatory environment. Antitrust scrutiny is intensifying. U.S. and European regulators have placed big tech firms under the microscope, targeting issues such as market dominance, consumer data usage, and anti-competitive practices. This adds uncertainty around compliance costs and potential structural changes in business models. Despite these pressures, opportunities remain compelling across several key areas. Cloud computing and SaaS. Continued enterprise migration to cloud platforms ensures steady revenue streams for providers of infrastructure and applications. Semiconductors. Demand for chips powering AI, autonomous vehicles, and advanced robotics positions semiconductor leaders for secular growth. Cybersecurity. The rise in cyber threats across industries makes cybersecurity firms essential investments, offering resilience even during downturn. Green tech integration. The intersection between digital technology and clean energy smart grids, IoT, energy-efficient computing, provides an additional growth runway. Within these trends, certain names stand out for their ability to navigate the challenging environment. For instance, companies with strong recurring revenue models and high switching costs for customers demonstrate resilience to economic fluctuations. Similarly, firms at the forefront of AI infrastructure or those offering specialized solutions in high-growth niches like cybersecurity are well-positioned. Additionally, companies prioritizing responsible AI development, including robust governance, privacy, and security measures, are likely to thrive. For investors, the key lies in discriminating between overvalued firms with fading growth, momentum, and those with durable competitive moats built on intellectual property, network effects, and recurring revenue models. Artificial intelligence, the defining megatrend of the decade. While technology broadly powers the digital economy, artificial intelligence has emerged as the central catalyst of disruption and value creation. The AI revolution is no longer a speculative concept. It is already reshaping industries, business models, and labor markets. Several forces define the current AI landscape, all of which present both challenges and opportunities. First, we have infrastructure bottlenecks. AI development is capital-intensive. The demand for advanced GPUs, high-performance computing clusters, and large-scale data centers has outpaced supply, leading to bottlenecks in semiconductor availability. This creates both risk short-term adoption limits and opportunity outsized pricing power for chip manufacturers. Second, energy and sustainability concerns. AI training and inference require massive energy consumption. The sustainability of data centers and the need for renewable energy integration are now central to the sector. Firms able to deliver energy-efficient AI infrastructure are well-positioned for long-term gains. Third, the competitive landscape. The AI ecosystem is highly fragmented, with big tech firms deploying billions in capital to maintain dominance, while startups focused on niche applications. This intense competition creates both challenges and rewards. Companies must innovate rapidly to keep pace while also ensuring defensibility and scalability of their solutions. Key opportunities lie in understanding where AI can deliver the greatest impact and where barriers to entry are the highest. Some sectors poised for AI-driven transformation include healthcare, financials, retail, and logistics. Within these areas, first-mover advantage and deep industry expertise are crucial for success. Finally, there's the ethical and regulatory environment. As AI permeates every facet of the economy, questions around bias, fairness, transparency, and accountability become paramount. Companies that prioritize responsible AI development, including robust governance, privacy, and security measures, are likely to gain trust and long-term success. In essence, AI should not be viewed as a standalone sector, but as an enabling technology that penetrates every industry. Companies providing infrastructure, semiconductors, cloud platforms, renewable-powered data centers, and those driving adoption, healthcare, financials, retail, logistics, stand to benefit most. For long-term investors, AI remains the secular megatrend of the decade, but the path will not be linear. There will be phases of hype, capital oversaturation, and eventual consolidation, which makes strategic selectivity essential. Financials. Margin pressure meets digital reinvention. The financial sector, historically a pillar of U.S. market stability, finds itself at a crossroads in 2025. While it benefits from cyclical economic rebounds and rising asset values, it also faces headwinds tied to interest rates, regulation, and digital disruption. Two primary challenges define the current environment. First, we have interest rate dynamics. The sector's performance is closely tied to monetary policy. As the Federal Reserve adjusts interest rates, net interest margins, or NIMs, fluctuate, impacting profitability. Banks enjoyed tailwinds during periods of higher rates, but as policy shifts toward moderation, pressure on NIMs is reduced. Second, loan growth and credit quality. Consumer credit demand is uneven, and rising default risks in specific segments, such as commercial real estate, pose challenges. Credit quality remains under scrutiny, particularly after stress events involving regional banks in recent years. Heightened regulatory oversight has increased compliance costs. Banks are required to hold higher capital buffers, while new stress tests impose stricter frameworks. This adds complexity and expense in the short term, but it also enhances systemic resilience in the long run. Despite these pressures, the financial sector is undergoing a profound transformation driven by digitalization and the rise of AI, creating a host of opportunities. Digital banking. Consumers increasingly demand seamless digital-first experiences. Banks that invest in mobile platforms, personalized financial planning, and digital onboarding gain market share. Fintech collaboration. Rather than competing directly, many large institutions are partnering with fintechs to accelerate innovation and reach underserved markets. The integration of AI across financial operations is perhaps the most transformative trend. Applications range from algorithmic asset allocation and high-frequency trading to advanced fraud detection and credit scoring models. AI reduces operational costs while enhancing accuracy and risk management. Wealth and asset management. Passive investing continues to dominate flows, but alternative investments, private equity, infrastructure, ESG funds are rising. Firms able to diversify offerings with AI-driven personalization are gaining a competitive edge. These trends highlight a financial sector in transition, one that faces cyclical pressures, but also stands to benefit from long-term reinvention opportunities. For investors, navigating this evolution successfully means staying attuned to interest rate changes, assessing credit risks, and identifying institutions that leverage technology and AI to enhance efficiency, customer experience, and risk management. In conclusion, while each of these sectors faces its own set of challenges, they are also at the forefront of innovation and economic growth. By understanding the interplay between these sectors, the broader macroeconomic environment, and emerging technologies, investors can position themselves to capitalize on the opportunities that lie ahead. Remember, successful investing in 2025 and beyond requires a nuanced approach that considers both the risks and rewards presented by these dynamic sectors. Don't just follow the headlines. Dig deeper to understand the underlying trends shaping the future of technology, artificial intelligence, and financials. Your insights will be rewarded. Thank you for watching.